Welcome to Finish First Financially's live stream, Monday edition. Goran Radanovic here. Thanks for joining us. So, another new week. Starting Monday, I was busy setting up at 7 a.m. Eastern Standard Time, so technically I was a minute late. I apologize. So I wanted to do a live stream today to talk about the secret of the great investors. Now, what is this one secret? Suppose, there's so many variables when it comes to investing that I've learned from my personal experience that help me to see profits, see profits in my investments. Go from seeing my portfolio drop 90% to eventually climb back up to break even and then go into profit, which was great. I think one of the biggest things that I learned was that it's a patience game. It's definitely a patience game. I think the one who holds out is the one who usually ends up reaping the rewards. That's not always the case if it's a bad investment, obviously, but if it's an investment that's proven to work that's proven to provide returns over a long period of time, and you stick it out, there's a chance that you might make some money off of it. So that was a big lesson for me when I watched my portfolio dip 90%. Well, not even dip, it was more like a crash. I just stuck it out. And this particular asset, which I'm not going to mention because I don't promote this type of assets, it's definitely not for newbies. So that's why I don't specifically mention it. But whatever it is that you invest in, as long as it's, let's say it's the S&P 500, which has a track record of yielding returns of on an average of 10-11% annually. That's not to say that it does that every single year, but that's the average. So if you stick it out over a long period of time, those are more or less the returns that you could see. It's not guaranteed, but you could see. Obviously, everything that I say is not financial or investment advice. It's purely for entertainment purposes. I'm just telling you my experience. So me watching my portfolio dip crash 90% was devastating. It was definitely one of the things that shook me, especially at the time, because I had debt and I decided, well, let me invest in this asset. And then when the asset takes off, I'm going to close my position. I'm going to make a profit. And then not only will I pay off my debt with that profit, but I'll also have even bigger savings. And that's not how it turned out. I just kept watching it go lower and lower until eventually it was a loss of 90%, but I stuck it out and I didn't sell the bottom. That was important. I did not sell the bottom, although I did buy the top at the time. And another big lesson that I learned, which, by the way, I'll get to this secret. I'm just mentioning you other things which are actually very valuable with regards to investing, is that now I forgot what I was going to say. It was the waiting and I can't remember it. It's crazy. I was thinking of the secret now that I was going to reveal. So now made me forget about the second thing that I was going to mention. So waiting. Oh, yes. Not doing anything, which is kind of related to waiting. So what does not doing anything mean? It means when the market is going down, you don't panic and then you just decide, well, let me get out before this gets worse, because that's usually the bottom. And then the price turns around and starts going to the upside. So I found that to be the case in many situations where I just wanted to get out. I thought, no, this is crazy. I'm losing money. I should just get out. And then when the price goes even lower, then I'll buy and then I'll make a profit. If I had sold as the price was going down, that would have been a big mistake because I bought at the top and I'm selling at the bottom. And then I'm thinking, well, it's going to go down lower. That didn't happen. Turn around, went up. So I stuck it out. I did not sell. Remember, only if I had sold, would I have lost. Even though I bought at the top and then the price is dipping. As long as I'm not selling, I'm holding out. There's a chance that the price could go back up to the price point where I bought at. And that's exactly what happened. And it actually went above that. I'm currently in profit. But it was important for, why I also, regarding this point of sticking it out and not doing anything, there were times where I sold. Once I recovered a bit and I sold and I went into another asset, and it ended up, I didn't lose money, but I didn't make money. If I just done nothing, if I just let the market play itself out, I would have made money. But I tried to think that I was smarter than the market. I'm going to get out here at these resistant points, and then I'm going to go into another asset that's going to go up, and I'm going to sell that asset, and I'll invest back into this one. It's a mess. It's a complete mess. And like I said, I would have been much better off had I done absolutely nothing. So that was actually an extremely important lesson that I learned. And this secret that I'm talking about, there's lots of things, as I mentioned, these two things that are very important when it comes to investing. Time in the markets, you need to understand how charts work. You need to understand Elliott wave theory to kind of get the lowest price possible, Fibonacci extensions to see how far the price can go and so forth. And these are more advanced techniques that very few traders really understand well. I've seen like a few guys that know what they're doing, that have been right consistently, not always, but consistently. And that's just not, that's that type of game to play for beginners. It's most likely gonna end up in losses. So that's not something that's for beginners, even intermediates. There's more for advanced stuff, which is guys that I follow. And, those are the guys who know what they're talking about. I have some knowledge of reading charts. I've been studying it for about 3 years. And I would say I'm intermediate at best after having traded. Let me just close this door, excuse me. It takes a long time to kind of know what's cooking with the charts. And one of the most important things, which is counterintuitive, is that the charts dictate the news, not the news dictating the price. So that's one of those counterintuitive concepts which most beginners don't understand. They think the news drives the price, whereas it's actually the charts that's determine the price and the news. So I'm not going to go into that, but what I will say is this. If you're asking yourself the question, what is the number one thing that I need to look at? Is it the fees, which are important? Absolutely, look at those. High fees can lower your profits. If you have significantly high fees that you're paying, and then you get a return of 10, 11%, and now it's low to 8 or 9%, well, that's a significant decrease of your profit. So you need to understand all of the fees that go into managing, and as an example, an exchange traded fund. And even if you're buying and selling gold, as an example, how much does that cost? Where can you do it? What are all the fees involved? What's the time period that it's going to take for me? Is it a liquid market? How long is it going to take for me to put this gold on sale? And how long can I expect there to be a buyer? So all of those things are important, the returns, potential returns. All of that is important, but it's not the number one thing that determines if your investment is going to be successful, believe it or not. Some people think, well, if my return 10x's, surely then it's the returns that are the most important, even if I've got high fees. I mean, I'm making like 1,000% on this asset. What's 4 or 5% in fees? That's nothing. And you can look at it that way, but there is one more thing that is much more important than the returns, and this has actually been proven to work to yield the most profit, and that is consistently funding that investment. Whether it's going up, whether it's going down, you are constantly funding it. That has been proven to be the number one strategy to a successful investment. To constantly keep every single month, you decide how much you can put away into this investment. Whether the price is going up, whether it's going down, you are investing in it. So it's not the interest rates that causes you to have the biggest. What good is the interest rate if you're not funding this account? What good is it to potentially have 10x's when you're not funding the account? When you consistently fund the account, that's when you've got the highest probability of gaining significant returns. It's consistently funding it. That's the strange thing. You know, even when the price is going down, you funding it. It's like, oh man, I'm losing. But remember, then the price goes up, and all of that, all of those investments that you put in while the price was going up is now compounding. Now it's just getting more and more. You've got now more shares. You've got more gold because you've been investing and so forth. So the most important thing when it comes to investments is consistently funding your investment. That is more important than the interest that you can earn. That is more important than the fees. It's more important than the potential returns. Whether the market is going up or down, you're consistently investing in a particular asset. That is going to give you the most likely chance of having a significant return on your investment. So let's go to this article that I wrote on finishfirstfinancially.com. It's called The Secret of the Great Investors. And I wrote it August 30th last year. Okay, so I said investing is a tricky game. You need to know what you're doing or you could end up losing your shirt. I know all about that. When I started investing years ago, I fell for the trap that most newbies fall for, buying when prices had already gone up exponentially. This is something that happens all the time. I see it in the market when newbies start seeing green candles and a particular investment is just going up and up. They can't comprehend that that could potentially be the top and that it's no longer going to keep going up, that it can actually reverse and go down. And the same thing applies to when the market is crashing. They can't believe that that could potentially be the bottom. They believe that it's going to keep going down and down. So then that's when they sell, and then thinking that they're not going to lose more money, and then that's when the price reverses and keeps going up. So, with regards to the investing game, so when prices already gone up exponentially, newbies think that they're just going to keep going up and up and up. This investment has already gone up 300, 400, 500%. Let me get in on it now because it's going to go up another 1,000%. And that's hardly ever the case. So they get in too early, too late, and they also, when the market is crashing, they also exit the market too early. That's what it is. Yeah, they exit as the price is going down, thinking it's going to go down even more, and then it turns around. I mean, you can't really blame me. It makes sense that prices will continue to rise, right? Yeah, I don't think so. Not only did I buy the top, I entered one of the most volatile financial markets, cryptocurrencies. I know. It was a bad idea, but that's part of the learning process. Most of us lose money before we learn from our mistakes and then eventually make a buck or two. What happened to me? Since then, I've learned plenty about investing, but not before my portfolio crashed 90%. Oh yeah, I forgot to mention that part. That wasn't fun, but I needed to get burned to know that I should never touch a hot stoveplate ever again. And luckily for me, I learned. One of the good things that I did was not selling in a down market. I learned that I lose money only if I sell. Sure, there's a chance that my assets could have gone to zero, but they didn't. As terrifying as the tumultuous roller coaster ride was, for years, I stuck it out. So I learned that I should just stick it out. But that doesn't mean that strategy is great for every asset. Remember Enron? Fortunately for me, the bear market eventually came to an end and I recovered lost ground as prices spiked up. That made me wonder about the things that successful investors do. Sure, they probably weather the storm, but there's got to be more than that. I figured they knew when the bottom was, so they bought when prices were low, and they surely must know when prices have reached the top. I figured out that most investors didn't know more than me. Huh? How is that possible? Surely they must know something about investing that I don't, and it's that one thing that made them successful. Sort of. It's not one thing they knew, but rather one thing they did. I found numerous cases of teachers, accountants, and courier drivers making $50,000, $60,000, or $70,000 a year and eventually retiring with a multi-million-dollar net worth. How? What was their secret? It wasn't that they invested in an asset that exploded and returned 1,000% in a matter of months, or that their investment had low fees. Something else. Prepare to have your socks blown off. Most of those smart investors knew even less about the financial markets than me, but they were successful because they did one thing I hadn't done. Smart investors fund their investments consistently. What a bunch of nonsense, you might say. Surely that can't be it. Just think about it. If you kept funding an investment every week or month for decades, I'm sure you would agree that the investment would grow significantly, right? Yep. A high rate of return hardly ever provides a bigger portfolio with infrequent deposits than a regular rate of return with consistent deposits. Okay, so let me read that again. A high rate of return hardly ever provides a bigger portfolio with infrequent deposits than a regular rate of return with consistent deposits. So what I'm saying is, it's if you've got two portfolios, let me quickly change the screen. If you've got two portfolios and one, let's assume that this is going to be the case. One portfolio has a high rate of return, but you're not funding that one. And the second portfolio has an average rate of return, but you're funding it consistently. This portfolio with the consistent investments with the average return is going to yield higher returns than the one with the high returns and no investments, even though you might have put just one, invested once in it, but you're not consistently in it. So this one with the average returns and consistent investments is going to be more profitable for you in the long run. That's usually been the case. Not to say that it's going to be like that every time, but that's usually it. It's the consistent funding of the investments that made regular workers such as teachers, accountants, and courier drivers retire with millions of dollars. The masters say that discipline and 1,000 hours of practice will lead to mastery. Well, by investing regularly, those regular workers develop discipline and tremendous practice. Whether the market was up, down, or ranging sideways, those multi-million-dollar retirees kept putting money into their investments. It's called dollar cost averaging. So let's look at dollar cost averaging. Using this investment technique provides several benefits. Firstly, it teaches an investor to ignore their emotions. So remember, when the market is going up, you're going to be greedy. When the market is going down, you're going to be fearful. So those two emotions could sway you in the opposite directions. When you're fearful, you might not invest when you should be. And when you're greedy, you might should be investing, but you are investing, but you shouldn't. That's usually what happens in those two scenarios. But what dollar cost averaging is saying is that whether the market is going up, whether it's going down, you keep investing. So your emotions of greed or fear are completely taken away. They are not affecting your decision to invest. You're doing it as a discipline, and you're doing it whether or not the price is going up or down. Using this investment technique provides several benefits. When the market is crashing and they're scared, they invest. When the market is in a bull run and they're greedy, they invest. So whatever they're feeling doesn't influence their decision. It's the discipline that makes them invest. The other benefit is that it decreases losses. Let's say you buy a stock when it's $100, then the price crashes to $50. If you hadn't bought when the stock crashed, your loss would be $50, the 100 minus the 50, so you're losing $50. But if you bought the stock again at $50, you would have lost only $25. That's because $100, so when you originally bought it, plus the $50 when you bought it again, those two together make it $150. Now you've got two shares, so you divide that by 2, and that makes your portfolio value at $75. Subtract that from the original investment of 100 and your loss is only $25. But the same is true in a bull market. Your gains are reduced. Let's say you bought a stock at $100 and its price increased to $150 when you bought it again. Had you not practiced dollar cost averaging and bought again $150, your portfolio would be worth $150. But since you bought again after the price surge, your portfolio's value is $125, which is 100 plus 150 divided by 2. So instead of a 50% increase, 150 minus 100, your portfolio increased by 25, 125 minus 100. Okay, so let's wrap it up. Evidently, there are upsides and downsides to dollar cost averaging, but the long-term benefit, which many regular workers who retired as millionaires proved, is that consistently funding a safe investment over a long period is very lucrative. While I do agree that that is a winning strategy, I also think it's important for investors to know what investment is safe. Fees can take a big chunk of profit, so it's also important to know all of the expenses and taxes involved. Those are also extremely important. But as I mentioned, at the end of the day, what it really comes down to is just consistently funding that account. That's really how it grows. That's how you avoid all of these emotions that come along with that. You're no longer worried about greed or fear, and you're just investing. Whatever is happening, whatever noise is out there, you see the news and you think the sky is falling, and like, why should I invest? Well, because I'm disciplined. This account eventually will grow, so I need to continue investing in it. I need to hold out. I need to continue investing in the good times and the bad times. And eventually everything should work out. Usually that is the case, not always, but that is one of the strategies that has proven to be extremely lucrative. Whether you look at your fees, whether you look at your returns, whether you look at which broker to use, the number one thing that has been the most effective at growing an investment is consistently funding it. That is the number one strategy. Although taxes and fees and returns, all extremely important, the number one element of investing that has proven to be successful over a long period of time is consistently funding that investment. That is the way to grow it. So, let me just close this door again. And that's actually proven to be true for my case as well. When the market was going down, sometimes I would invest and then the price would go down. I'm like, man, what's going on here now? Why should I invest again? But then you invest and then you kind of average it out. And that's really what it is. Looking for those averages as opposed to just a once-off investment and then hoping to see what's going to happen with it. That comes back to the scenario of what I was talking about, the high returns with only like one investment as opposed to average returns with consistent investments. That second option is usually proven to be more successful. Obviously, all investments are risky. Doesn't matter what it is, whether it's real estate, stocks, crypto, it's all risky. There's no guarantee of returns. So you should be careful. Obviously, speak to a financial advisor. As I mentioned before, I was just sharing my experiences. This is not financial investment advice, purely for entertainment purposes. I wanted to let you know my story, see if there's any value in it. If you thought that some of my mistakes is something that you want to avoid, that's up to you. You could choose to avoid them so that you don't end up with a 90% portfolio loss like I did. And then on top of that, I still had all of this debt that I needed to pay off. So that wasn't a great position to be in. One of the things that I'll never do again is invest while in debt. I'm debt free. First of all, I'll never go into debt ever again, but I'll definitely never invest while in debt, because investment returns aren't guaranteed. That's one thing that you need to keep in mind. But what is guaranteed is that debt repayment. If it's outstanding, you need to repay it. It's always going to remain outstanding until it's paid. So the debt is guaranteed, but the returns from investment aren't. Once you take your savings and you pay off that debt and it's paid off, you don't owe anybody. That's a guaranteed thing. That's a sure thing. And you no longer have to worry about anybody calling you. And that's exactly what happened to me. Once I paid off my debt, then I had the savings that I could put towards investing. And obviously, the only amount that I was prepared to invest was the amount that I could lose. When I invested in something, in my mind, my mentality was, am I going to be fine if I never see this money again? Is it going to affect me so much that I'm going to be hurt financially, hurt emotionally? Because if I am, then that's probably not worth investing in. Then that's an investment I can't make. So once I made an investment, it's almost as if I had written it off. Forget about it. If it so happens that I make money off of it, great. If I don't, well, then that's just the way it was. That was money that I could afford to lose. So that's my mentality that going into an investment. And I think obviously the most important one, which is what we've covered, is the importance of consistently funding that account. So not only is that vital for building discipline when it comes to investing, it takes out all of the emotions out of investing, greed, fear, and it just enables you to focus on putting money into that investment every single week or every single month, however you choose, whatever you decide is best for you, and to just keep growing it. Obviously, you want to do your due diligence on every investment. Past performance does not mean that it's going to repeat itself. An asset could yield returns for 10, 20 years, and then all of a sudden tanks. So there's absolutely no guarantees with investments. Just keep that in mind. So that's why I say, for me, when I invest, it's a case of, can I afford to lose that money? If I lose all of that money, am I going to be in a world of trouble? And if I am, then I'm not going to invest. That's just how I see it. Other people are making much more drastic, taking bigger risks in investments, hoping that they're going to pay off debt, hoping that they're going to build savings. Sure, that's their thing. I wouldn't do it, but each to their own. Whatever you decide is your thing. I'm just telling you what I did and what's worked for me. And I think it's worked for many other people. It's just a strategy. There's obviously outliers. Somebody who's taken on massive risk and it's paid off. that happens sometimes. But what also happens a lot is taking on a lot of risk that you can't afford and then losing everything. I think that's happened much more than the few cases where people chased risk and made money off of it. I think that happens a lot less. So that's it for today. 7 a.m. Eastern Standard Time, Monday to Friday. We will talk about another personal finance topic. Hopefully you enjoyed this. Join me again 7 a.m. I'll check you then. Bye-bye.